Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I'd say from a market perspective, the focus is definitely more on the job side and potential downturn in the economic data. Tariffs are going to be interesting. Undisciplined spending, if we see that next year, that'll be interesting. And I think the Fed cares about it all. They do have a dual mandate, but the market's definitely putting more weight, especially as we close out the year on the jobs data. And we have seen inflation data controlled, right? So that's what's turning the focus to the jobs market.
We've been thinking that they should and that they will, so that they will cut in December, and then we're going to get a hawkish dot plot when they do their forecast for 2025. Right now, there's 4 cuts marked down for 2025. We think that that could get marked to something closer to 2, which would effectively say it gives them the door that's open to cut if they feel that they need to, but also not to commit to cuts.
The U.S. needs Japan, particularly as we gear up to go really hard at China. That trade escalation is already expanding. China announced this morning that they're restricting some of their critical minerals exports back to the U.S. This is a situation where we need allies, and the Biden administration operates with that in mind. The Trump administration has not historically.
We got 1 hour to go until the market closes. So let's take a look at the major averages. We've got a mixed picture today here, Josh. So we've got the Dow trading lower here by around 50 points, about 0.1%. The S&P 500 up very slightly, just actually perking into the green in the last, call it half hour or so. And the NASDAQ up about 0.25%. So not seeing big magnitude of movement here in terms of the major averages.
Yeah, I mean, I wonder how much of this, Julie, could be some wait and see going on, just because you do have key jobs data on deck for later this week. I wonder if that's a play. I also think some interesting kind of cross currents. I mean, in terms of risk for stocks, we've talked a lot about tariffs, and we're going to speak to a very smart strategist in just a second about that. But also geopolitics has always been one. That's certainly reared its head again in South Korea. And then frankly, too, Julie, I mean, we've just so relentlessly driven higher here. It is worth noting, I thought it was interesting that some strategists today pointing out to their clients that sentiment, at least by some measures, by some gauges, is getting really stretched to the bullseye.
Yeah, well, and that's something that our Lori Calvasina of RBC told us yesterday as well. Even though her target for year end next year is 6,600, she said we could see a 5 to 10% pullback. Before then, one of the reasons, or one of the signals, I should say, that she watches is that AAII investor sentiment, which she said is getting a little bit to stretch levels. This looks at the NASDAQ here over the past week or so. You can also look at it on the 10-day basis and see that much higher that you are talking about. I also want to take a look at the sectors in the S&P on the day here to see where the sort of pressures are. We've got industrials, financials, materials that are down, communications, services, energy, and financials on the rise. So there's not a lot of thematic necessarily moves in today's session in terms of what's up and what's down.
And big earnings after the bell today. Salesforce on deck.
Looking ahead to that one.
All right, stocks here are set to close out a strong 2024, but one strategist points to a few hurdles markets will have to clear to have the same success in the new year. For more, let's now welcome in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeff, always good to see you and have you on the show. I want to talk about the incoming Trump administration, Jeff. And, I think investors are trying to sort through that, taxes, deregulation, but it's really tariffs that I think are front and center right now for investors. And I'm curious, Jeff, as a market strategist, how are you thinking through that dynamic?
Well, they certainly do pose a risk to growth next year, but I think the bark is probably worse than the bite. If you take a look at every single tariff threat that President Trump has thrown out there, and we have tallied them up, you end up with a 26% import tariff on imports into the U.S. That's up from the 2.6% rate it is now. That's massive. It actually exceeds the Smoot-Hawley tariffs that preceded the Great Depression. But we think, the bark is worse than the bite. Maybe a 10% tariff as opposed to going all the way up to 26. And the IMF looked at that scenario in their latest World Economic Outlook. What would be an across-the-board 10% tariff and the impact on economic growth? Globally, just 0.1% less. So I think that's something we can absorb and still see better economic growth outside the U.S.
You know, you're not the only one who, everybody seems so confident that the full tariffs will not be put into place. Why is everyone so confident that that's the case? Is it because, I mean, there was some level of tariffs obviously put in during the first administration, but why does everybody seem to be drawing that conclusion?
I think there's three reasons. One, there were trade deals in the first administration as well. So while tariffs went into place, we had a phase one trade deal with China. We had the USMCA agreement with Canada and Mexico. We even had a free trade agreement with Japan and South Korea negotiated during the first Trump administration. Second, I think he's using tariffs not as economic policy, but as statecraft. Notably, what was announced last week with regard to Mexico, really trying to get the border shored up, less about actual tariffs. So I think it's a tool for statecraft rather than the policy itself. And then finally, I look to other examples around the world. We've seen so many incumbent governments tossed out with right-leaning governments, more antagonistic toward trade. And a great example is what just happened in Europe and their imposition of a 45% tariff on Chinese electric vehicles. That was, I mean, we are in the process of unwinding that right now. It just went in place on October 28th, I believe, or the end. Yeah, not long ago. It won't last very long, I don't think. We're very close to seeing negotiators work out a way around that in favor of quotas or price limits. So I think there's a number of examples where we could see where we're probably not going to see the worst case scenario.
Well, one other reason, Jeff, too, is we did have analysts come on, and here was their case. They thought that ultimately the policy will be more moderate, more orthodox in the rhetoric. And their reason was just because Trump's, for his own self-interest, for his own success, he's going to want to maintain some basic level of market and economic stability, particularly for a president who we know likes to use the stock market as his kind of record of how he's doing.
Bingo. Yeah, he's absolutely very much in tune to the stock market, more so than the average president. And the markets are very quick with their feedback around what's going on. I mean, you've seen that today with political travails in South Korea or in France as well, right, this week. There's a lot going on, and the market's giving a lot of feedback to policymakers.
So if you don't think tariffs are going to be that worst case scenario and be a risk for markets, what is then the biggest risk to markets then? Or what are some others that you're watching that could unfold a little bit more dangerously for the market?
Well, there's a few things. One thing, the market is really counting on rate cuts, not just from the Fed, but other central banks. The ECB priced in 6 rate cuts over the course of the next year. Yet inflation in the latest readings, almost everywhere you look, went up. And there are some signs that maybe inflation's maybe gone down as far as it's going to go. We might see a bounce here. So the risk that those cuts don't materialize with valuations in some ways predicated on that increase in liquidity, that's a risk. Geopolitics are a risk, evidenced by what's going on this week. And then finally, related to the Trump administration, deportations are a risk to labor costs in the U.S., but also to Mexico. Mexico gets 3.6% of its GDP from remittances from Mexican nationals in the U.S., sending it back to Mexico. So there's a number of different issues we need to keep a close eye on.
Jim, I was talking at the top of the show with Julie there, and we mentioned sentiment. And it's interesting because you'll listen to strategists, and valuation is seen as a bad timing tool. But those same strategists will often say, hey, but you should watch sentiment. You should watch positioning. What are sentiment and positioning telling you?
That there's a lot of optimism still around tech and AI. And we're starting to see that shift outside the U.S. For example, financials are the best performing sector outside the U.S. in the second half of this year. They're rate cut beneficiaries. I think that could be more of a story of next year, a rotation away, maybe a second wind to the market in areas that really haven't performed well. Valuations for financials outside the U.S. still below average, have room to move on the back of stronger earnings.
What are other places that could get that second wind?
I really like, from a geographic perspective, Europe. Because one, valuations are so low. We've seen a number of those economies go through recessions over the last 6 quarters. They're emerging from that. At the same time, rates are being cut aggressively. And so I really think you could see a good PE bounce over there. So you get modest earnings growth, 1 PE rise in the PE ratio, plus a 3% dividend yield. You're looking at double-digit returns for international stocks. I wish we saw that this year.
What about what is going on politically, I should say, in France, for example, what has happened in Germany? You know, how's that going to affect the economics and markets in Europe?
It's hard to believe, but it actually could improve them because it's really a budget battle. And so what we're seeing is that the president in France wants to spend less than the opposition does. And so what you could see is actually less fiscal austerity in France, and that could actually boost economic growth. So it's interesting to see how this plays out. And certainly there are bond spreads widening between France and German bond yields. But on an absolute basis, French yields are actually lower than they were before the snap election was called. So the macroeconomic impact isn't necessarily negative, could even be a little bit of a boost.
And so we talked US, we talked Europe. What about China? Because I think if memory serves, last time you were on Yahoo Finance, not a big fan.
Yeah, I'm still concerned that they're overpromising and under-delivering on stimulus. I don't see that changing next year. I will say this, though. Back at the end of 2016, when Trump was elected, it was widely expected China to be the worst performer in his first year, and small caps would be the best performer. And sure, that played out at the end of 2016, but not in 2017. China was up 56% in 2017 on the back of better global economic growth. So it could be that economics matter more than politics.
And then, since we're talking about China, we have to ask about South Korea. We keep kind of dancing around it, right? So the president there announcing martial law, then the parliament there saying, no, you can't impose martial law. And apparently he's just given a statement on TV in the last hour or so saying, okay, fine, if the assembly doesn't want martial law, I'll pull back from it. So it's developing very quickly. Something else might have happened since the last time I looked. But what's the effect not only on South Korea, but then on the surrounding region as a result of all of this?
Well, this is, again, one of the issues of an incumbent government having been tossed out and a new government being put in place, and there's a real battle in the legislature. This is about a budget battle, once again. You've got the president wanting to spend on some things, and the opposition does not. And so it's really about different ways this budget battle plays out. If you take a look at the South Korean stock market, I think it's down 1% or so today. Not, of course, the stock, but the ETFs that track the South Korean stock market. Not a big move there. And I think in recognizing this is really about a budget battle, it looks like geopolitics, but really just comes down to simple fiscal policy.
Interesting. Jeff, thanks for coming in. It was
Pleasure.
great
Thanks
to
for having
see you. Really appreciate it. There is a new Wall Street high for the end-year target for the S&P 500 for 2025. Yahoo Finance's Josh Schaefer, is joining us now with more.
Josh,
A James Bond joke.
Yes.
Julie. So the new target, the highest on Wall Street, is 7,007. 7,007. That coming from Wells Fargo's Chris Harvey. And really, Chris laying out a pretty similar case to the other bullish calls that we've been tracking, guys, in terms of year-end outlooks. That's about a 16% increase from where the S&P 500 is right now. And sort of the key quote in here is talking about a Fed easing cycle, right? We're talking about a Fed easing cycle. You guys were just talking about perhaps a Trump administration that could be a little bit pro-business, right? A lot of strategists highlighting that. And then the overall earnings picture here. The overall earnings picture expected to be strong. Going into next year, earnings expected to grow, margins expected to grow. Key part to this call, which is not dissimilar again to some of the other calls, more broadening of that rally. So Chris specifically highlights he likes the S&P 500 equal weight, which would move more in the broadening of the rally rather than the S&P 500 market weight, the one we talk about a lot, actually SPC, that gets carried up by big names like NVIDIA. So him highlighting perhaps more rotation in the market to come in 2025.
Well, and you said he's the highest out
Yes.
there, but where are we seeing them sort of cluster, right? It's like sort of 65, 6,600?
65, 6,600, which is about...
high single digits.
Yeah, I was going to say,
roughly.
depending on where we're at on the S&P 500 on a given day, it's about high single digits. It's also about the average annual return of the S&P 500 in any given year, which is normally kind of where these targets lie. But I think notable from this, we haven't really had a bear yet. The lowest call is 6,400. I believe that's from UBS. And Chris Harvey from Wells Fargo wrote in this note, I wanted to be bearish. That's not an exact quote, but he said he wanted to be contrarian. And then he looked at the data and he simply couldn't really find a reason why. And I found that kind of entertaining,
Maybe
right? 'Cause
that's concerning.
Well, I think what he said, and this was something you were just talking about, Josh, with sentiment that's getting more and more bullish. You have positioning that's bullish, right? There's a million indicators. Valuations are high. There are a million sort of those reasons we could think.
Although valuation, I
it's-
mean, 11 months I've heard about
Right,
valuation.
and think it's coming, right? But then when you look at the data, the thing with something like valuation, high valuations are a problem when something goes wrong, right? And my earnings projections are going to fall. Right now, when you look at something like the economy and what people are looking at in the labor market, there isn't a flashing red sign for people to then say, this is when valuations are going to become a problem. That's when your unwind happens. And so in the current state of play, perhaps the biggest risk that people are highlighting is inflation. We've had flat inflation prints for a couple months now, and I think the question is, do those get better going into 2025? Or are we looking at less Fed rate cuts?
Well, right, and that's something that Jeff Kleintop was just talking about, that is a potential risk for the market, that we're still pricing in too many cuts. But
What if we get no cuts?
what if we get no cuts, Josh Schaefer?
Deutsche Bank's call, it's out there, Julie. People
Yeah,
are talking about
yeah,
it.
I know. Well, we'll see what happens.
see.
And by the way, we're going to be speaking to Abby Yoder at the top of the next hour. JP Morgan Private Bank She's also at 6,400.
There we go.
Tune in, everybody. Tune in, Josh Schaefer. All right, we're just getting started here on Market Domination. Coming up, shares of Zscaler are sinking today after the company's latest earnings report that included some weaker than expected guidance. We'll speak to Zscaler CEO Jay Chaudhry in the 4 p.m. hour to talk about the quarter and what lies ahead. And at 4:30, the CEO of AWS, Matt Garman, will be joining the show as Amazon's cloud computing arm is unveiling a massive AI supercomputer. Stick around, all that and more when Market Domination returns. The Federal Trade Commission's reported antitrust investigation into Microsoft is focusing on the tech giant's deal with OpenAI. That's according to The Information. Yahoo Finance's Dan Howley is here with more of the details. So there had been reporting that there was some kind of probe. This gives us more details. And, you know, this OpenAI, the partnership's pretty vital to Microsoft.
Yeah, vital to Microsoft, vital to OpenAI. Obviously, Microsoft being the big beneficiary here, OpenAI getting access to Microsoft's Azure capabilities, but Microsoft being able to use OpenAI's own models for its own capabilities. So things like its Bing, Copilot, you name it, Microsoft is integrating OpenAI's technology into this. And, you know, as you said, there's been reporting about this before, so it's not exactly a surprise that the FTC is looking into this, but it's not as though they've kicked off a antitrust investigation. They're not accusing the companies of any wrongdoing at this point, but they are, you know, kind of probing what's going on here and whether or not the relationship gives Microsoft an unfair advantage in the still relatively nascent generative AI space. It's something that I think we're going to see more kind of probes into with regards to Anthropic and Google and Amazon and all these companies. And there was discussion, I believe, earlier this year or last year about the kind of big tech going in and hiring or backing some of these AI names, and whether or not that means that big tech will hold on to its already prodigious advantage that it has in the space and box out smaller competitors or not. So again, this isn't something that's entirely unexpected. It doesn't necessarily mean that there's going to be a lawsuit, but it is something that I think Microsoft is obviously going to be keenly aware of, as well as OpenAI, when it comes to the future and their competitiveness in the space.
Dan, I want to switch gears and talk about another big name, that's Intel. So, it was interesting, Dan, the headline drops, Intel is going to part ways with its CEO, Pat Gelsinger. Initially, Dan, you saw it. I mean, the stock actually popped on that news. Today, though, we reversed, different story. We're down about 6%. Reality, is it setting in here, Dan, about the challenges ahead for this company, regardless of who's in the C-suite?
Yeah, I think there's two things. There's a lot of people liked Pat as the guy to kind of turn everything around. They didn't necessarily like the third-party foundry, the manufacturing foundry for other companies, for its rivals. They didn't like the idea that Intel wanted to be a US-based kind of TSMC. And so they liked Pat, didn't like his idea to do that. I think on the whole, they would have wanted to keep him and ditch that idea. Now, though, if they do go ahead and ditch that, or they go ahead and kind of shuffle off the entire foundry, separate that from the design side, what does that mean for the CHIPS Act funding that they just got, that $7 billion plus that's earmarked for them as they hit different milestones? And so, I was talking to some folks about this throughout the day yesterday and today, and essentially what they say is, look, if Intel wants to keep that money, it's going to be tough. There are certain provisions in there that prevent Intel from giving up control of the foundry business. It would be virtually impossible to do that and keep the CHIPS Act money unless there's some kind of renegotiations. I think generally the thinking is most people want Intel to continue to manufacture on its own products, but again, ditch that kind of third-party manufacturing idea. And it's not that it's gotten off to a good start. Its biggest customer is still Intel. It has some wins. Microsoft and Amazon saying that they're going to go with Intel and use its 18A node for chips that they would then use. But that's not, the NVIDIAs, the Qualcomms of the world that TSMC has. So they would need to really build up scale. And so, if they end up ditching that idea, still having their own manufacturing, though, they would end up probably having to cut back on some of the plans they have for building out different manufacturing hubs along with that third-party idea. So that would mean, eating some of the money that they've already put in and then potentially not getting as much of that CHIPS Act funding overall. Now, what does that mean for the Commerce Department and their plans that they had for Intel? We're just going to have to see with the incoming administration.
We will. Put it on the list of so many things. Dan, thanks so much. Appreciate it. Now time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most trafficked stocks of the session on Yahoo Finance's trending tickers page. First up, we're taking a look at shares of Coupang after the South Korean president sparked political uncertainty, not just Coupang, but really anything South Korea based here, including the ETF that tracks the South Korean market, the iShares that tracks it, EWY. And that's because South Korean markets were closed when President Yoon declared martial law there. Now, the National Assembly said, no, you can't do that. There were protests. And then in the last hour or so, he's come out and said, okay, I'm going to listen to the Assembly and lift martial law.
Yeah, this one was,
happening.
There was a lot of headlines. You had to sort of follow the bouncing ball here. But declared martial law, which was obviously a shock and a stunner,
Yes.
said the decision was made to protect freedom and constitutional order. But, you had these headlines dropping, okay, we're banning all political activities and strikes. To your point, lawmakers then weigh in. And then the latest headline, it did sound like, okay, the president says he's going to lift martial law. Regardless, I mean, no surprise when you have those kind of bouncing headlines like that. We did see ADRs of companies with ties to Korea. They did come under pressure. So you named some of them, Coupang, POSCO, also iShares, MSCI, South Korea ETF. I saw that was slipping in today's trade. So bouncing all around.
Yes, most definitely, and it's not done, right? We'll see what happens next. There had been some protesters calling for the president to step down. Even before this, there were some threats to his tenure. So it seems like that this is still going to be a debate.
Yeah, I mean, there was open questions. We mentioned some names that folks were also, Julie, bringing up. What was it going to mean for those big chip makers, you know, SK Hynix, for example. So keep on it.
Yeah.
Turning to MP Materials, those shares rising as China says it will ban the export of several rare minerals to the United States. You can see up about 12%. That was just one name that was gaining on these headlines. Does come, China bans the export on several materials that do have this kind of range of military and high-tech applications. Apparently this was a response, Julie, to Biden's technology curbs on Beijing that were placed just yesterday.
Yeah, so I love the names of these minerals, by the way. We've got gallium, germanium, antimony.
I'm impressed you can just say them.
Thank you very much. Molybdenum is my favorite, but wasn't on this particular list that I'm aware of. But in any case, they're not allowed to be shipped to America under these new curbs from China. So that's why you saw companies that produce either in the U.S. or in Canada that can maybe gain some market share. It seemed to be that was the supposition based on this. So we'll see if this ban ends up getting extended and if indeed these companies do gain some sales as the result of this.
Yeah, it's been this, long-standing issue and concern, just China being a big supplier of these critical minerals, their dominance in the space.
Yes. And let's also take a look at shares of Honeywell, that company cutting its outlook for 2024. It has squarely to do, though, with an agreement it reached with Bombardier, the Canadian aircraft maker. The companies have been in dispute over the development of some aviation technology for decades now, really. The seeds of this happened long ago. And so the agreement is going to then eat into Honeywell's results for the year.
I saw analysts kind of weighing in on this one. At least the coverage I was seeing was broadly positive, Julie.
Yes.
I saw Citi, which has a buy on the name, says telling their clients creates good long-term opportunity. Told their clients yes, guidance lowered to reflect the agreement, but unlikely they said that financials would be impacted beyond the quarter.
Right, and eventually this agreement between Honeywell and Bombardier, they're going to collaborate on things like engines that eventually it could be worth $17 billion in revenue. At least that's what the companies themselves are saying.
Yeah, but Barclays, also a fan of the name, says it sounds to us as if any share price weakness on this 24 guide cut represents a buying opportunity.
Oh, we'll see.
We're sticking with it. All right, coming up, we are taking a look at the ripple effects Trump's tariffs could have on various industries, including building materials. Stick around, much more market domination still to come.
As Americans brace for President-elect Donald Trump's proposed tariffs, we're taking a look at the wide-ranging ripple effect it could have on building materials and other industries. Patrick Industries is one of the biggest suppliers of building materials to makers of recreational vehicles, boats as well. Joining us now, the CEO of Patrick Industries, Andy Nemeth. Thanks for being with us. Appreciate it.
Thank you so much for having me.
So we're trying to suss out the effects of all of this, right? So talk to us about it for your company. You guys provide supplies to RV makers, things that, paneling that goes onto the RVs, et cetera. So how's your supply chain look right now?
Sure. As one of the largest component suppliers to the RV industry today, our supply chain is very healthy. And as we're looking at the tariff impact that could be out there, we've really worked hard over the last couple of years to mitigate our exposure as much as possible and alternative source to different countries to make sure that we've got dual sourcing opportunities in our markets today. So we've worked hard to do that. There could be a little bit of impact, but one of the other things that we do is we provide a good, better, best product offering to our customers. So even if there is a little bit of tariff impact, we offer the opportunity for them to downscale or decontent a little bit to offset some of that. So we'll work actively with those customers, like I said, to mitigate as much of that impact as possible.
I'm just curious, Andy, when you say the last couple of years you've worked hard to kind of mitigate potential impact on the supply chain, was that in any way due to, listen, you all were kind of just reading the political tea leaves of what was going on in this country and recognizing, hey, we have to take certain steps, reorient?
Oh, without question. We saw kind of the environment changing. It felt certainly like there was exposure there as it relates to supply chain in general, just being able to procure product. And so we've been the last probably 2 to 3 years really active in mitigating our risk by more than a third from what we do in China. And like I said, we don't source a lot overseas. It's not a significant piece of our business, but there is risk there, and we've done it all we can to mitigate that.
Let's talk about consumer spending too, because there was an RV boom during the pandemic, right? Boating as well. Then we've seen it come down a little bit. So where are we in that cycle now?
Sure, we are at the bottom of the cycle as it relates to both of those markets, and they are kind of bouncing along the bottom right now. The good thing about it is that the inventory that's out in the dealer channel is really leaned out at this point in time. And so as we look at our business today, we see there's opportunity for a restock that the dealers are going to need to do at some point in time. Interest rates have been the biggest hangover that we've had as it relates to a dark cloud kind of affecting our markets, whether it's retail financing or whether it's dealer inventory financing. And so the dealers have really leaned everything out. So it's positioned very well, but they're bouncing along the bottom.
And so let me ask you this. I'm curious that when people are buying RVs right now, has the kind of RVs, the types of RVs they want changed, evolved at all over the last few years?
It absolutely has, and right now it's smaller units are the largest mix of units being sold. So it's
Why
really
is that, Andy?
Price point is what it is. It's the cost of the units, and the monthly payment buyers, are very focused on that, and so they've had to. The RV industry has done a fabulous job of, like I said, they as well offer a good, better, best kind of content offering to allow consumers up and down. But yeah, right now it's kind of low-end units and smaller units.
So, okay, so if it's good, better, best, are people buying smaller but maybe spring for the better finishes, or are they going more budget on both counts?
More budget. Consumers still want content in their units, even if they're a little bit smaller. But what usually happens, and where we get optimistic, is that those consumers generally upgrade over a period of time. And anytime you upgrade, you're going to move to a larger unit that's going to have more content in it. And therefore, as we supply our customers to the space, we're going to have more content in those units as well.
I have to ask you, Andy, also, these headlines I saw that we're going to have these 6 states that are going to limit, I guess, the sale of new gas and diesel-powered RVs. First of all, walk me through what is going on there. And secondly, how does that impact potentially your bottom line?
Sure. The push is really in California at this point, and there's 5 other states that are involved in this legislation that is effectively going to preclude the sale of RVs, of gas-powered RVs, and so the motorized sector of the industry. California represents about 15% of the total motorized market today on a retail basis, and then the other 5 states, if you add those together, it's a little over 20% of the motorized market. That being said, The motorized market is only about 10% of total RVs. So from our business perspective, it only represents about 3%.
What's the motorized market?
There's a motorized market, which is going to be a motorized unit, and there's a towable market. And 90% of the RV sales today are in the towable side of the business.
I did not know that.
But it does impact California and those 5 other states. I mean, right now they are going to be precluded from selling and registering RVs. They're effective January 1st.
So finally, if we're bumping along the bottom now, what is the thing that you're waiting for to unlock that upturn? Is it going to be more of a decrease in rates, or is there something else you're waiting for?
2 things, really: a decrease in rates, a little bit of rate inflection. Is we need a little bit more rate relief, and then consumer confidence. So those are the 2 things that really propel our markets. And so if we see a little bit of that, we would expect a little bit of inflection at some point here.
All right, Andy, thanks so much for coming in.
Thank you very much for having me. I really appreciate it.
Yeah, thanks. Well, Tesla's polarizing Cybertruck may be hitting a demand rut. Joining us now with more, Yahoo Finance's Pras Subramanian. This has to do with what? A little bit of pause in manufacturing, Pras?
Yeah, possibly some issues here with that polarizing Cybertruck. Yes, Business Insider reporting that Tesla emailed Cybertruck line workers at Giga Austin, telling them to take the next 3 days off this week. And this isn't the first time this has happened. Apparently in October, 4 workers told BI that several times after arriving for work, they've either been sent home or given additional duties like training exercises or actually cleaning. So anytime you cut shifts at a factory, you're cutting supply. It's likely that Cybertruck supplies are building up. Even on Tesla's website, I checked today, if you order a Cybertruck in the New York City area, you can have immediate delivery. That means there are trucks here right now. That wasn't the case just a few months ago. And on top of all that, the Cybertruck qualifies for that EV tax credit, both for purchase and lease. And if this goes away, as some surmise, they'll likely hit sales too, even further.
And Pras, how important is the Cybertruck to Tesla's bottom line?
It's at the margin one of these vehicles that I think they've sold. Cox says they sold around 26,000 Cybertrucks through the first 9 months of the year, which is nothing compared to the Model Y and Model 3, which are in the hundreds of thousands of vehicles sold. But it's not nothing. It is the top-selling EV pickup, if you believe it or not, in America. It's better than the Rivian, better than the Ford F-150 Lightning, and those are very, very comparable competitors there. So it's not nothing there. These are they're selling more than these other guys are, but compared to the other vehicles, it is sort of, I don't want to say drop in the bucket, but it's less than 10% of their sales are Cybertrucks.
All right, Pras. Thank you, buddy. Appreciate it.
Thank you.
Elon Musk is expected to be a significant voice in President Trump's second administration, but whether he's an official voice or not brings up many questions and concerns. And joining us now is Richard Bruffault, Columbia Law School Joseph P. Chamberlain Professor of Legislation. Richard, it's good to see you. So listen, Musk did bet right on Trump's win. He seems to have impact. He seems to have influence. Of course, we know Musk and Vivek Ramaswamy are going to be leading our new Department of Government Efficiency. Of course, this has raised, Richard, some questions about potential conflicts of interest for Musk. I'm curious how you're thinking through that dynamic.
Sure. I'm thinking about it in 2 ways. One is kind of formal legal considerations. And for that, a lot's going to turn on what exactly is the DOGE, the so-called Department of Government Efficiency. There is no department. If there was going to be anything like a department in the sense of like a cabinet department, like the Defense Department, Congress would have to create it. And that's an elaborate process. So it's almost certainly not going to be a real department. If it becomes something more formal, like an advisory committee, and there's a law that governs them, they'd have to have public meetings, they'd have to keep public records, they'd have to be accessible to the public. We'd have a better sense of what they're doing. If it's just what it is right now, which is, I'd say, a couple of guys who have the ear of the president, apparently the trust of the incoming president, and a powerful megaphone, they surely could have a lot of influence. They could certainly have a big impact on what the president asks for and tells the bureaucracy to do. And they could use it in many ways that could be helpful to their personal interests, but they would be technically outside of a lot of the legal regulations designed to control conflicts of interest.
Would there be any recourse then, Richard, if indeed there were those conflicts of interest? Would it be, it sounds like legally there wouldn't be, would it then be up to folks in the press, for example, or, who could possibly play that role?
as I said, if it's formalized somewhat, there would be some issues about things like making sure they have public meetings, keep records, keep the public up to date on what they're doing. But you're right. If it stays as informal as it is now, it's going to be up to the press, up to Congress, maybe the Democrats in Congress more than the Republicans, to highlight those actions that they're going to be proposing that may be to their personal benefit. I mean, Musk in particular has been entangled with a half dozen or more federal agencies. He's in contract with a bunch of them. He is being overseen and has in conflicts about with the SEC, with the Labor Board. There are environmental issues with some of his activities. So the things that he's proposing could potentially be things that may very well be good ideas generally, but could also have a direct personal benefit for him. Less clear on Ramaswamy's interests, but he also may have financial interests that could be affected by the kinds of policies that he and Musk are recommending. So in that sense, there's a potential for conflict, for real potential for that. And I think a lot of it's going to be the only real oversight on that is transparency and public attention to what they're doing and public understanding of what are the benefits of what they're calling for and what might be the personal benefits, personal to them, benefits of what they're calling for.
And just, Richard, just so I understand the process correctly, Congress would have to agree with Musk and Ramaswamy in order for their recommendations and suggestions to actually become law?
Some would not. It really depends on what they're proposing. Deep cuts, elimination of certain programs, yes, Congress would have to would have to agree to that. Some other things might be more in the control of the president, might be more in terms of the directives that he gives to his agencies. Some of them might be things that the agencies could do by regulation, although even then the regulations would require a kind of process. There's not a lot that can be done just by say-so. There's going to be a process, either agency processes or Congress, but some things the president would be able to do, I think.
Well, and then there's sort of the intangibles as well, Richard. I mean, there was some reporting in the Wall Street Journal that Sam Altman of OpenAI, who Elon Musk sees as a rival, and that's become increasingly, the animosity there is ratcheted up, that Altman is having trouble getting an audience with people on the Trump team, and that's seen as a direct reflection of Musk's feelings towards him. But I guess those kinds of that kind of chemistry, if you will, and personalities, that can happen in any sort of administration. It's just you don't normally have somebody who has a company like Musk who's hanging around.
Right. It's not something it's something that's hard to regulate by law, but it is something that's worth paying attention to. That the idea that there's one or a very small number of people that have such enormous influence on the president and can steer policies. Steer policy about AI, for example, which is going to be huge. Policy about crypto, policy about internet regulation. All these areas in which these gentlemen have significant interests. The fact that they have that kind of influence is something can really warp the kinds of decisions that a president can make, the things the president can recommend to Congress, and I think that's what people have to look out for, to be aware of, and to be ready to respond to. I mean, I'm not saying that there will be these terrible things, and they may have some good ideas, but I think this is one of those things where the media, other interest groups have got to keep their ears open and their eyes open, be willing to speak up.
So that's the bottom line then, Richard? It seems to be, is that what you're saying? Listen, if we're going to have Musk involved, and some would argue, I'm sure, he's the right guy to be involved. This is a, historic entrepreneur who has upended and redefined multiple industries. But your point being, if he is going to be involved, then let's make sure there is adequate disclosure as well along the way.
Absolutely, yes, absolutely. Okay. And know what they're saying, know who they're talking to, and to the extent we can, kind of, to put it, kind of crudely, know what it's in it for them. I mean, hopefully we'll see what's in it for the country as a whole, but also we should be aware of what may be particularly in it for them.
Richard, great to have you on the show today. Appreciate that insight, sir.
My pleasure. Thanks very much.
On the latest episode of the Yahoo Finance podcast, Living Not So Fabulously, NBC News and MSNBC correspondent Stephen Romo sat down with hosts David and John Ottenschneider to discuss the ways that his experience with childhood poverty stuck with him as an adult. You can scan the QR code below to check out the latest episodes, and be sure to tune into Living Not So Fabulously every Wednesday at noon. Here's a look at this week's episode.
Trying to unlearn so much of what I learned about money from growing up, it's been the work of a lifetime. My parents they didn't talk to each other about money. They fought about money. They did not hide their money problems from my siblings and me. That we had 2 homes foreclosed on. We got kicked out of rental homes. And we were always very aware of what was happening. Like we couldn't afford this. We couldn't pay for this. So that's one of the reasons why it's been hard for me to engage with money and learning about money, because once I started making enough money where I wasn't having to worry about paying bills and paying student loan payments, then I sort of stopped making myself think about money. That was what I thought my reward was. I don't need to think about this.
All right, let's get to our call of the day now. Bernstein downgrading FedEx from outperform to market perform. You can see the stock down about 4.5% in today's trade. So team at Bernstein, no longer big fans here. They also cut their target, by the way, to 316. Average on the street is 308. Thinks they're going to lower their full-year outlook, Julie, when they report later this month. Says the Q1 miss and underwhelming Q2 forecast suggests they see a heroic second-half earnings ramp would be needed to meet the revised guide.
And he doesn't think they're going to make it, right? He doesn't think that the second half is going to, the earnings are going to allow it to meet those estimates. He talks about the integration that the company is doing of their express and ground networks, as something that is going to be challenging for them. The company, by the way, reports after the bell on December 19th. The shares up about 13% year to date. So, it's okay. UPS, by the way, in contrast, down about 17%, so they have outperformed them. And most folks on the street, more bulls than not, 20 buys and 14 holds, 2 sells on the stock, but one less bull.
Political angle here, too, by the way, thinks increased tariffs under Trump, among other changes, could impact air freight volumes.
We'll see. Well, holiday season is heating up, and so is the spending behind it. We're looking at how buy now, pay later companies play into this year's holiday shopping. For more, we're bringing in David Chiaverini, Managing Director of Equity Research at Wedbush Securities. David, it's good to see you. Apparently, Adobe is looking at $18.5 billion in holiday spending financed with buy now, pay later. It's a little bit of an uptick from last year. What do you think here? How important a part of the financial system is buy now, pay later at this point?
Yeah, it's still a very small share of overall, retail sales. Right now, BNPL is a high single-digit share of e-commerce spending, and e-commerce spending is a mid to high teen share of overall retail sales. So BNPL is still a relatively small share, but with that said, the growth is very much higher than the overall sales growth. So I think the outlook for BNPL providers is favorable here.
So when Dave, a lot of viewers listening right now, when they think BNPL, they think Affirm, but you're on the sidelines on that name, David. Why are you on the sidelines? What does Max Levchin have to do to get you more bullish on his company?
Yeah, so what's keeping me on the sidelines is the valuation. Now, fundamentals are trending in the right direction, but a valuation perspective, it's trading at about 8 times EV to sales, which for us is on the expensive side. But I have to give them credit that credit quality has been better than expected. Growth has been very strong, and we are expecting continued strong growth over the next few years. So if we were to see a dip in the stock, that could get me off the sidelines.
Well, and it's interesting that you mentioned the credit quality piece, because one might, at first glance, look at these companies and think, well, they're lower quality borrowers, maybe there's higher default rates among them. How do you approach, or what do you think of Affirm's modeling and maybe some of the peers of the industry more broadly as well?
Yeah, I've been pleasantly surprised with the level of credit losses that they've had over the past few years, because you're absolutely right. They target kind of middle America. So when you think of the FICO spectrum, they are right in the middle. Think, near prime, subprime type of borrowers. But their underwriting has been very strong. Their modeling has been spot on. They're looking at kind of low single digit type of loss rates when you look at the loss rates on a trailing 3-quarter GMV basis. And I would have expected that to be higher. So they're keeping that in check. And I think that they're going to look to actually expand their underwriting standards, given that they've kept their margin in a decent place. For instance, their revenue less transaction costs margin, they want to keep that in a 3 to 4% range. They're at the upper end of that range. And now with the outlook for lower interest rates, it could take them above that range, all else being equal, but they're going to loosen underwriting standards and be willing to take on more losses to generate more GMV growth.
David, another name I want to get your take on, because you only have one underperform in your coverage universe, David. It's just one lonely cell sitting there, and that is SoFi, which has enjoyed, it's a nice move this year. It's up around 60%. Why do you remain bearish on SoFi, David?
Yeah, so SoFi, that's our paired trade with Lending Club, and Lending Club has actually outperformed SoFi when you look at the year-to-date figures. So when you look at the business model of SoFi versus Lending Club, they're actually quite similar in terms of the FICO range that they are targeting for borrowers, and the credit quality has been similar. But when you look at the valuation discrepancy between Lending Club and SoFi, it's too wide to ignore. So that's when I keep the underperform on SoFi and keep the outperform on Lending Club. But I'll give SoFi credit that they have been right in the sweet spot of this kind of fintech rebound that we've seen this year, and they've been benefiting. But if it weren't for their valuation discrepancy with Lending Club, we would be more favorable towards SoFi.
David, you cover the broader financial universe as well, and I'm curious when you look at the fintechs versus what some folks call TradFi, right? Traditional finance, with rates going down, but maybe not going down as much as had been expected. Which of those segments sort of stands to gain or conversely be hurt the most by the current trajectory for rates?
Yeah, so good question. When looking at the traditional banks that I cover, given the forward curve has shifted around a lot this year, and recently it looks like with tariffs and the potential for inflation that the forward curve, as you noted, may not go down quite as much as originally thought. So that should benefit some of the asset-sensitive names in our coverage. So First Citizens, FCNCA should be a beneficiary there, as well as First Horizon, FHN, and then Zions Bancorp, ZION. They should also benefit in this forward curve environment. And if it doesn't shift lower like it had looked just a few months ago.
David, good to see you and good to see you on the show. Thank you.
Thank you. My pleasure.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings report from Salesforce. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's market domination overtime. So let's take a check on where the major averages ended this session here. Starting with the Dow, we've got a little bit of a downdraft here by about 0.2% for the Dow Jones Industrial Average. The S&P very little changed here and the NASDAQ up about 0.4%. If you take a look at the Wi-Fi Interactive here, I'm also looking beyond the three major averages because we've been watching some other areas very closely. It looks like, by the way, the NASDAQ's at another record today with this gain because it closed at a record high yesterday. So at another record close today. The S&P 500 also, actually, if it's higher, is at a record close, even though it is a very slim gain on the day. But the equal weight index down 0.4%. And this is interesting because we keep talking about the broadening of the rally here that has been occurring. And yet this shows that, at least for the past couple of sessions, it has been large cap tech that has been leading the gains. Ditto goes for the Russell 2000, which we're seeing a bigger decline for that index, even though a lot of folks like that area right now. I mentioned large cap tech, so I want to take a check on that area as well. Most of the Magnificent Seven higher, not all, but Meta in particular getting a boost of 3.5%. Microsoft higher on the session, even after we get that report from the information that what the Federal Trade Commission is looking into regarding the company has to do with its partnership with OpenAI. We heard our Dan Halley talking about that earlier. The stock still, though, managing to eke out a gain on the day. Tesla shares lower after that Delaware judge said to Elon Musk, nope, your pay package still is not kosher, even after the company shareholders voted again to approve it. So we will find out what happens with that, if there is some sort of appeal or what goes through. We've been talking about the sectors as well on the day, communication services and tech leading the gains, as we mentioned here. So the leadership coming from large cap tech, and today not seeing that broadening trend that we've been talking so much about.
All right, third quarter results for Salesforce are just now hitting the wire, so let's take a look at those numbers. You can see the stock, at least initially here, we're down about 0.5%. Headlines, Q3 adjusted operating income, $3.12 billion. That's versus a street $3.01 billion. I see Q3 sales, Julie, $2.12 billion. The estimate was $2.06 billion. Turning to their outlook, it looks like they're seeing Q4 adjusted EPS 257 to 262. Street was at 265. Q4 revenue looks like 9.9 billion to 10.1 billion. Street was closer to 10.05 billion.
Yeah, so I think safe to say that fourth quarter revenue forecast may be a little light of estimates, and expectations were high going into this report. There's been a lot of enthusiasm around Agentforce, which is the company's AI offerings, among one of its AI offerings. And so we're seeing some discussion going into this report that investors really wanted a little more clarity on the profitability of some of these new efforts. You know, this has been a question for a lot of these software companies. They're introducing all these AI tools. What is it going to get them? What's the ROI going to be? So the shares, as you can see, bouncing around a little bit here in the wake of these numbers coming out. So we'll see, what investors end up focusing on in these numbers.
Yes. By the way, I now see that Q3 adjusted EPS 241. Looks like the street was at 244. To your point, Joe, there have been well-known sort of challenges for CRM and other software names, macro challenges, longer sales cycle. But that stock had really popped heading into this print. I mean, it was up about 30% in just the last 3 months. So you did see kind of sentiment improving around the name. Analysts will argue that this is kind of this very critical, important period for Salesforce and Mark Benioff, in the sense that kind of they'll argue he's just really now laying the groundwork to bring these AI agents to the enterprise mass, as they say, new pricing and packaging. Of course, that also means new investment.
Yes, and he tries to talk about that investment as being disciplined in the statement. Benioff, of course, touting Agentforce and saying that we're not just witnessing the future, we're leading it, he talks about doing with that tool. But he says we continue to drive disciplined, profitable growth. He points out the third quarter GAAP operating margin is 20%, which is up 280 basis points year over year. So what he seems to be trying to, that's Amy Weaver who's talking about the operating margin, the CFO. Total capital returns, she says, have surpassed $20 billion. We remain focused on driving shareholder value. So to your point, seems to be what they're trying to communicate there is we're not doing this at any cost, right? We still are focused on profitability even as we are investing in these new endeavors.
The stock has turned higher now after hours. Nice pop.
All right, well, Wall Street's rally hitting the pause button today, perhaps, as investors wait on the jobs report and the upcoming Fed meeting. Our next guest is bullish heading into the new year, 6,400 target on the S&P 500. Joining us now, Abby Yoder, JP Morgan Private Bank U.S. Equity Strategist. Abby, it's good to see you.
You too.
So 6,400 indeed implies gains, but not very big gains.
Not given where we are today.
Yeah, why not?
Well, I mean, look, when we underwrote this was actually, a week after the election, right? We wanted to see what happened with those results. We didn't think we were going to get them as quickly as we did. But, we had gone through all the scenario analysis based on, let's call it 4 outcomes. And we had, differing price targets based on that. And the 6,400 was a result of that red sweep. And at that point, we were not at, 6,050. So it was closer to a double-digit gain at that point in time. But the breakdown of that, right, if we're thinking about what are the components of that return, let's call that a 6 to 8% return today, is going to be a contraction in multiples, right, down from, let's call it 22 and a half times today to 21 times. But that you're going to be offset, you're going to see that offset from earnings growth, right? So you're going to see, we're below the street, I would say, in terms of consensus, in terms of earnings growth, we're at around 11%. I'd say the street closer to 15%, but still positive in terms of an earnings growth outlook. And importantly, 2 years of above average earnings growth, right? So 11% in both 2025 and 2026, which is above the historical average of, let's call it 7.5%.
And Abby, you mentioned that election, and you did get that red sweep, and you must be getting a lot of questions from clients about what that means: taxes, deregulation, tariffs. How are you trying to sort through that?
Well, I mean, it's nuanced, right? It's going to matter sector by sector. And for our clients, we're talking about really thinking about taxes as it relates to the deficit, and down the road, how that really plays out is important to our client base. But the thing that I think the biggest takeaway from a headline level is that the growth impulse, right, as a result of, let's say, the extension of the Tax Cuts and Jobs Act, will offset what we think would be headwinds from tariffs, right? Headwinds from, both from a growth standpoint and an inflation standpoint from tariffs. And that really has to do with, I would say, the deregulatory agenda. And that's really, I know what financials have been the epicenter of that, and that's how it's been expressed in the market. And we do like financials as a result. But it's really across industry. We saw a very large magnitude of regulations increase over the past 4 years. And if you think about it, okay, financials stand to benefit as a standalone entity, right? Because they're very regulated. But if we think about cross industry, if you have all of these regulations that are coming off, you're going to feel more compelled to invest. You're going to have more clarity on what's going on over the next couple of years. So that means loan growth for financials as well. So a lot of positives that are coming through in terms of that.
It was interesting. I was looking at a recent analysis of commentary and conference calls. And efficiency is a word that has seen an uptick and is persistent. Do you think, we were just talking about Salesforce sort of reading between the lines here, that they're making it clear that they're spending, but they're still going to be profitable. Do you think that there will be a little bit more unleashing of spending as a result of some of what you're talking about?
I think if you're talking about outside of, let's say, the hyperscalers and Mag 7, yes, right, because they have been spending.
Yes.
And the whole question is what is the ROI on that, as you were speaking about earlier. I do think there's an element of, yes, there's an unleashing of animal spirits in the sense that, companies can feel a little bit more supported in a less regulated environment. Now, that's being said, we don't want to abandon all regulation. It's not like all regulation is bad. But if you think about the economy over the past couple of years, it's really been bifurcated, right? It's been this services-oriented, new economy has been doing fine, whereas the manufacturing sector has been in essentially a recession for the past 2 years, right? We've had the PMIs below 50 for, the better part of 2 years. And we got some data yesterday that suggested, it's still in contractionary territory, but it's moving higher, right? The ISM Manufacturing Index. And so I think that's really where you can see upside, right? It's in those more cyclical parts of the economy. And again, it's going back to that deregulation, because we're not seeing a huge growth impulse from an economic standpoint at the moment.
And in terms of sector, so you like financials, you like industrials. You downgraded healthcare, though, to neutral. How come?
So that actually wasn't really anything policy related. Things have changed since then. I would say that whole landscape is much more uncertain, and you can see that in the price action, and that it's the worst performing sector since the election. And that really wasn't our thesis. That wasn't why. The main reason was really from a bottoms up standpoint. We just weren't finding that many names that we were particularly excited about. And then if you think about secondarily, the pro-cyclical tilt and impulse that's happening as a result of the election outcome. We just don't really want to put, the incremental dollar in a defensive sector necessarily. And if we do, and we have the choice, we'd prefer utilities. So we're overweight utilities, and we've downgraded healthcare as a result because we just don't want that much money flowing into defensive sectors in the current environment.
Gotcha. All right, Abby, good to see you. Thanks for coming in.
Thanks so much.
Stick around. We've got much more market domination over time still to come. In the past month, several stocks and sectors have felt the impact of Donald Trump's election win, the so-called Trump trade. Joining us now to help us understand how retail traders have been thinking since the election, Steve Quirk, Robinhood Chief Brokerage Officer. Thanks for coming in.
Well, thank you so much for having me.
So how have we seen the Trump trade play out specifically with retail?
Well, it started really the evening of the election. We started to see movement. We allow trading on 1,000 symbols 24/5. And so right about 7 p.m. Eastern, before the states were even called, you started to see a divergence in, the contracts that were indicating who was going to be victorious. And so the whole crypto complex took off. Tesla took off. Volumes there went through the roof. All the stocks that were viewed to be potential beneficiaries of Trump's regime, just saw the movement and the acceleration in the prices. And so what we've seen since that point and up to the last month is some profit taking in some of those names because a lot of our customers were already beholding some of those names, so they'll take some profit taking. And then where there's opportunities where they see some stocks that have been depressed a little bit, like NVIDIA, which is very popular, they'll add to the portfolio there. But overall, if we just look at the RIX index, looks at the performance for the month, and we gauge it against the NASDAQ.
And it's the stocks that Robinhood users hold the most.
Yeah, it's very democratically designed. So we take the top 100 holdings of each customer, and we say it doesn't matter if you have $20 or $20 million, what percentage of your portfolio is in that stock. So the conviction, if you will. And then we aggregate that and then we measure that against the broad-based market and say how did they perform against a broad-based market, and they basically doubled the performance of the NASDAQ over the last month.
And Steve, you mentioned the election.
Yes.
You rolled out prediction markets.
We did.
That was only about a week before the election,
It
right?
was a week before, yes.
And you're not the only one, obviously. Others saw opportunity there. What makes your product different, do you think?
I think the product that we rolled out, it was only one. It was only one, and that was, you were just selecting whether it's, a Republican or a Democrat. That was the winner. But the interest in that was just off the charts. We opened 500,000 accounts. We had 500 million contracts traded. But moreover, we saw so many people coming to Robinhood just to see them. And say, okay, wait a minute, now that it's 70-30, oh my gosh, I need to rebalance my portfolio, I need to be opportunistic and take advantage of this. And so it became a really nice vehicle for them to access market-moving news.
Now, a lot of your career has spent amongst retail investors, designing stuff for retail investors, watching retail investors. What do they tend to get right that the pros don't? And conversely, what's the biggest mistake they make?
I think the thing that they get right, and this is it was really evident, like in 2020 during COVID, when there was a lot of, I think it's been written about quite a bit, and you guys have reported on it, everybody has, there was a lot of institutional selling into some names that became very depressed, and retail stepped in, and they really benefited from that. So I think what retail customers like to do is they like to invest and create a portfolio and trade the things that they have an interest in, that they understand, and that they're passionate about. And they've had success with that. I think the thing that, the retail moniker is like, careful, don't time the market. I have a perfect example of this. I have 20-year-old daughters that, I help them invest, but when the market goes down, and of course they use Robinhood, they'll call and yell at me. And I'm like, hey, I'm not the person running the market, but, I tell them, and they do it now. I said, listen, we have a reoccurring investment capability, which says, I want to put $100 in the market in these 4 stocks, and I just do it every single month. And if you want to look at it occasionally and see how you're doing, great. But I said, I can't use the word guarantee. It's not allowed in this business, but I have a strong conviction that you will thank me 20 years down the road for just investing in that manner. And it for retail customers, that helps them remove the emotion. It's an emotional thing other than your health. Your wealth is something that people are very concerned about, and they should be.
Steve, great to see you on set.
Thanks.
Nice to see you. Thank you so much for having me.
Thank you, Steve. Zscaler posting strong results for the first quarter, but that stock reacting to the company's guidance as well as the announcement of its chief financial officer retiring. Here to walk us through all of it is Zscaler CEO Jay Chaudhry. Jay, it is good to see you. As always, let's start with that earnings report, Jay, because this is the first time we had a chance to catch up, get your take. Jay, I saw some analysts on the street who cover the company, and at least some of them were saying, Q1, well executed, the guide, in their words, tepid, but I wanted to get your take on the report and the forecast. Walk us through what you're seeing in the business, Jay.
So Josh, Q1 was well executed, very strong results. If you look at our revenue growth, 26%, our free cash flow margin, 46%, record high, our gross margin, over 80%. In fact, we really delivered the rule of 70 plus. Most SaaS companies aspire to do rule of 40. And this rule is You take your revenue growth plus free cash flow margin to get to 70, puts on a rarefied air. About 5 of the top 145 companies are in that space. I think it's wonderful. Sometimes the market focuses too much on day-to-day stock price. I think if you do that, you miss out on the big picture. We are focused on the big picture to protect our customers, to make them safe.
And Jay, if you focus on the big picture as well and look ahead to 2025, we've been talking a lot today about the outlook for the economy, the outlook for the markets, the outlook for the enterprise spending cycle. And on that front, Jay, what are you seeing in terms of your billings, in terms of your outlook for 2025, in terms of the strength of that enterprise spending cycle?
Yeah, I talk to lots and lots of CIOs and CISOs out there. The market remains tight. There is scrutiny on large deals. But if you do two things, CIOs will want to work with you. Number one, good cybersecurity with zero trust architecture, because the firewall-based, VPN-based security is no longer working. But along with cyber, if you can tell the CIO that I can take some cost out and save money, you can get the deals done and you can deliver good numbers. That's how Zscaler has done business. That's why 45% of Fortune 500 companies now are our customers. So we have a pretty strong outlook for fiscal 25 or calendar 25.
Jay, another headline that came out of the report that I know the street was very focused on were some changes in the C-suite. Your CFO is retiring. Those are big shoes to fill. Jay, walk us through that news.
Yeah. Remo is a great CFO, is a great friend and partner. He joined me before Zscaler went public. It has been a great partnership for 8 years. And he did want to retire. People want to retire at some stage of their life. The good news is Remo is staying with us till the successor is selected and successor is on board. Our search has already started, and we have lots of interesting and capable candidates to join us. So not at least worry about it. And Remo will remain as an advisor even afterwards as well.
You mentioned the sort of scrutiny of large deals that you're seeing on the part of your customers, and you well know it's a competitive environment, right? So everybody's trying to eat everybody else's lunch here. So what's the plan in the next year to close those large deals, to keep those large customers, Jay?
For us to close large deals, customers are looking for having an integrated platform that can eliminate a bunch of point products that don't work well and have highly operational cost. We are one of the few companies that actually do cost elimination. We eliminate firewalls, VPNs, VDI, segmentation, a lot of those products. In fact, many times when we show the ROI for our customers, they kind of say, it's too good to be true. A lot of other companies can't do it. Take, for example, firewalls. The biggest install base of security is out there, firewalls. You think firewalls guys can save costs? Not really. Zscaler can, and that's why our customers are buying our products. You saw a number of 7-figure deals we did and announced during the quarter.
And Jay, we always want your broad take as well on just the overall threat landscape. Jay, a lot of bad actors out there. What are you seeing?
It's getting worse and worse. You had all these guys doing traditional phishing and the like. Now AI is out there. AI is powerful. AI is dangerous. But we need to fight AI with AI. So we are actually adding AI-powered capabilities that can help find a needle in a haystack, find some bad threats. I think the big thing enterprises need to do is shake off inertia and embrace some of these newer, better technologies. When it comes to the type of threats, nation states want state seekers, nation states want to use it as a weapon, and the other guys want to make money. That's why ransomware attacks are on the rise, and we are helping our customers. I personally believe that Zscaler customers are a lot safer than customers who depend upon firewalls.
Jay, always great to have you on the show. Thank you for making time for us.
Josh and Julie, thank you for having me.
Time now for What to Watch Wednesday, December 4th. And starting off on the Fed, we're going to be getting some more Fed commentary throughout the day tomorrow, including from Fed Chair Jerome Powell. This is coming after comments from San Francisco Fed President Mary Daly today. Daly telling Fox Business that a December rate cut could still go either way. Fed Governor Christopher Waller, remember, also saying yesterday that he is inclined to cut rates next month.
Taking a look at earnings, we've got some more big names reporting tomorrow, including Synopsys, Foot Locker, and Dollar Tree. Foot Locker announcing results for the third quarter before the opening bell. Analysts there expect sales will accelerate, driven by store refreshes and a relaunch of its loyalty program.
And moving over to jobs, monthly ADP employment numbers for November coming out in the morning. Economists forecasting that number to slow to 150,000, giving us more insight into the non-farm private employment in the U.S.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Amazon Web Services big day, unveiling a massive AI supercomputer and a new server. We're going to get the details on that and much, much more with AWS CEO Matt Garman. It's coming up straight ahead. Plus, a muted day on Wall Street, but the Nasdaq and and the S&P 500 were able to close at new highs. We're going to have a look at what was behind the market action and the trading day takeaways. And Salesforce shares, they are jumping on the heels of third quarter earnings. We've got analyst reaction coming right up. Well, Amazon Web Services revealing its new servers and its next generation AI chips. Amazon's cloud business also announcing its Trainium 2 instances are now generally available. Amazon Web Services CEO Matt Garman joins us now to discuss, along with Yahoo Finance's very own Madison Mills. Matt, it is great to have you on the show. So listen, you made a lot of news today, Matt. We have new AI chip arrays, new large language model to better compete with the likes of OpenAI. But walk us through the highlights, Matt. I mean, bottom line, what does the news today mean for your customers and your business?
Yeah, part of what we did today was announce a whole new set of capabilities across a lot of different things. And as you mentioned, there was a number of announcements in AI, and we're incredibly excited about those. One of the key pieces is we did GA our Trainium 2 chip, which is our own custom developed chip inside of Amazon AWS to help really drive down the cost and increase the performance for generative AI capabilities. And so we expect customers to see 30 to 40% price performance gains by moving to Trainium 2. And so really excited about what we're seeing with Trainium, and a number of early customers, including folks like Anthropic, including folks like Apple, are really excited, have been doing some early testing on Trainium and like the results that they've seen there. We also launched a number of features around capabilities on building AI systems and services, as well as you mentioned that we launched our own Nova models, which are new foundational models built by Amazon that deliver really great latency, great performance, and a great set of capabilities across a wide set of areas that we're really excited about, and I think really add to the selection that customers have using Amazon. The other thing is we also launched a ton of features that really enhance the rest of our AWS services, some big changes in storage that really help people with their analytics capabilities, and some new databases that we think are going to help customers be able to scale in a much better way.
Matt, let's pick up on the large language models announcement. The model's called Nova, by the way. You say that you can compete with the likes of OpenAI with this model. Why is that?
Well, really what we said is that we're trying to provide customers choice. And we think that customers want to use a wide range of models. Sometimes they want to use open weights models. Sometimes they want to use text models. Sometimes they need multimodal models. And so our view is that customers want to mix and match a variety of different things. And part of what we do in AWS is give customers that choice. We give customers the choice to use the leading models, which many consider the leading models out there to be the models from Anthropic. But also, customers want to use a variety of models for different things. And we started building the Nova models inside of Amazon, and we really saw some great benchmarks coming out of there. And we thought there was a great opportunity for us to expose those inside of Bedrock for customers, further expanding the choice that they have, selecting from a wide variety of models.
Matt, Patrick Moorhead, well-known, well-regarded tech analyst, frequent guest on this show, Matt. He has argued that you all, in his opinion, have the broadest, deepest homegrown chips in the industry. Full stop. But he's also pointed out, listen, your rivals are coming in hot. Microsoft, Google. How do you then, Matt, think about maintaining that lead?
Well, look, we've built up a capability for a long period of time. In fact, we've had a general purpose processor called Graviton now for many years, and I think others are just starting to get in this game. And we have a saying that we like to use internally, that there's no compression algorithm for experience. What that means is we've learned a lot of how to go build chips, how to execute on chips, and also how to take requirements that we learn from customers of what they want from those processors and do a good job of quickly iterating those into the next generation of those processors. And so we think we've built up a competency there, and it's part of the value that we deliver to customers as part of that compute choice. And so others may others may get into the game of kind of building their own custom silicon, but we think that it's up to date has been one of the things that really differentiates AWS, and we think we have quite a lead over where everyone else is. And so and by the way, we're also not resting, right? We just a couple months ago launched our new generation of Graviton 4, that's allowing customers to save oftentimes up to 40% over x86 alternatives. And we think Trainium 2 is really a leap forward in Gen AI processing. And we announced that at the end of next year, we'll be launching Trainium 3, which again doubles the performance you get from Trainium. So this is a long-term roadmap that we're investing in, and we're showing customers and have over a long period of time that custom silicon is a nice option. But it is just that option. It is something that we also use as a supplement to all the technologies that we use from the rest of our partners, whether they're Intel or AMD, and especially NVIDIA, where they're a close partner of ours, and we use many of their chips, and customers really love the instances that we built together as well.
Well, let's talk about that, because you've been very clear that NVIDIA is a partner for you, but they are the dominant force in the market when it comes to GPUs, specifically for training AI. Does the Trainium 2 chip announced today and the tease ahead for Trainium 3, does that position you to take more market share from NVIDIA in the future?
Our view is that it should grow the entire size of the pie. And that really is our goal. We think that we're at the very early stages of where the generative AI market is going to be. And we think that there is explosive growth ahead of us. And we think there's more than enough growth for more than one player out there. And so, I think this is not about who has how much market share. It really is, how do we grow this together? And I think actually having more options for customers will help more applications come up and help the whole market get bigger. And so we continue to think that our business with NVIDIA will continue to grow, and we're very bullish on the future of that. And we think there's a great opportunity for Trainium 2 to come in and offer new capabilities for customers as well, and help them really lower the cost for particular workloads.
To that end, Matt, this idea of growing the pie when it comes to AI, one of the big questions for investors, executives, has been, when is the spigot of capital flowing into AI potentially going to get turned off? What have you been hearing from customers at AWS specifically about the CapEx on AI and whether or not that's going to potentially hit some headwinds moving forward?
Well, what our customers tell us is they're interested in how they can continue to move these proof of concept generative AI applications into production. Because really, once you start to get value in production, that's when the use of AI goes up, and when a bunch of these investments start to make sense, and people will invest more and more and more. And so our take in AWS is that we build this platform that allows people to deeply integrate with their enterprise data and their enterprise IP in a secure, safe environment where they can get real enterprise value. And we actually encourage customers to think about the ROI of their generative AI applications before they roll them out. And so really thinking about that, if we can lower the cost of compute, if we can lower the cost of running a model and increase the value that customers get, all of a sudden the ROI barrier goes way up, and customers can launch more and more and more of these capabilities to deliver outstanding capabilities for their own customers. And I think that's where that really flywheel starts to happen. As we lower the cost of doing what we call inference, right? Going and actually getting these AI models into production, then it frees a lot more applications to start using that inference much more extensively.
Matt, when it comes to sort of the kind of pecking order of AI, there is this perception out there, Matt, and you've heard this, and I'm interested to get your take, that you all are running late. That you look at the rivals, so the argument goes, Google basically created this, the science of Gen AI, and Microsoft running very hard and very fast. The perception being, but you all running a bit late to the game. Talk about that perception, Matt, and your response to it.
Well, it's it is just that. It's a perception. It's actually just a different strategy that we had. And so many of those other companies that you mentioned, their strategy was to get out there something fast, right? They wanted something flashy. They wanted something that customers could go and launch a proof of concept with quickly. Our strategy was instead, we actually know that our enterprise customers and the customers who are really trusting us with their business wanted a platform that was really going to transform how they think about doing their business, how they think about the core parts of their enterprise. And so we spent the time to think about, how do we have the right security? How do we have the right controls around your data? And how do we have the right choice? How do we make sure that there's enough models you can use? How many enough capabilities? And increasingly now, we're starting to see this strategy really play out, where people are tired of doing proof of concepts that don't have any kind of value associated with them. And they really are looking for, how do they take the proof of concepts that look promising and actually now re-implement those in a production environment. And AWS is often that production environment, and Bedrock gives them that platform to go and do that. So we're very excited about where we're at right now, and actually we're increasingly see customers turning to AWS and Bedrock to build their real production generative AI applications.
Matt, a slew of announcements today. One of them is that Apple is one of the customers of these latest chips. Talk to me about some of the cost savings that they are experiencing utilizing Trainium and the degree to which Apple Intelligence is relying on Trainium chips specifically versus other chips in the space.
Yeah, well, today, Apple Intelligence, and we've been partners with Apple for over a decade now, and they're great partners, and many of their technologies are built on the AWS cloud, from storage to compute to databases, all up and down the stack, and they use many of our services. In the AI space, the first product that Apple actually used was Inferentia 2. And so this was an early AI chip that we built that really gave them some confidence and helped them significantly lower their costs. Now, they've only done trials on Trainium 2. Again, we just GA'd it today, but they've had some early samples that they were testing, and they're very bullish that going through 2025, they can significantly lower their costs and deliver outsized value to their customers. I think on stage today, they mentioned that they might be able to lower their costs by as much as 50% by running on Trainium 2. So that's really exciting, and it's great early signals for us that Trainium can scale to some of the largest customers in the world.
Matt, final question here. Let's talk politics. Trump administration coming in. It's possible, Matt, he slaps tariffs on all kinds of countries. I'm curious how you're preparing for that, Matt, how you're readying your supply chain to mitigate any kind of possible impact.
Yeah. Well, look, number one, the U.S. government is a fantastic and big customer of ours, and so we've supported many administrations over the past 2 decades, and we'll continue to do so. And we're very excited about supporting the Trump administration. With regards to tariffs, we'll of course deal with whatever comes down the path. But I think our take is that we're here to support the administration and what they're trying to accomplish, and we do want to do what's best for our customers as well, and we'll advocate for our customers and their needs. But again, the U.S. government has been a big customer of ours for a long time, and will continue to do that. And we're very invested in making sure that the broader U.S. government and the Trump administration is quite successful.
Matt, great to have you on the show today. Thank you so much for your time and your insight. We appreciate it.
Thank you for having me.
Markets closing mixed as investors digest jobs data and Fed speak. Here with the trading day takeaways is Yahoo Finance's very own Josh Schaefer.
Hey, Josh. Yeah, I want to start with some labor market data that we got out this morning. That's from the month of October. It's the job openings and labor turnover survey. And one economist said it might be a sign of the labor market finding a floor, that slowdown that we've seen in the labor market, perhaps finding a bottom. This, of course, Josh, is not the big jobs report we're going to get on Friday that looks at November. This is looking at October, but it's a very detailed report. And what we're looking at here is job openings coming in at 7.74 million. And when you see 7.74 million, the key part here, little bit of an uptick. We had sort of just been trending down for months. So to see a little bit of an uptick, and you're back at levels where if we look all the way across here, you're slightly above pre-pandemic levels. So maybe you're holding at a steady level with job openings and you're not just going to see them keep moving lower. That would be a general positive. The other note to highlight out of this report, quits ticked up. So the quit rate is seen as a sign of confidence in workers. I'm only going to quit my job if I feel like I can go get another one, right? So as people feel more sour about the labor market, remember we had a lot of softer jobs data in the summer, right? Quits rate was coming down. Even when you look back in the past year, Josh, 2008, your quits rate goes way down, right? So to see the quits rate coming back up, perhaps a sign that people are starting to feel a little bit better about going out there and finding a job. It is by no means the labor market of 2021 where people are going out and getting big pay bumps and everybody's got a new job, but maybe we're in an okay labor market, a cooling but not concerningly cold labor market.
Cooling, not crashing.
Cooling, not crashing.
I was going to ask you what you think Jay Powell makes of the report.
I think overall what economists say that Jay Powell would make of this report is probably still a cut in December, and it doesn't really do that much for the narrative going into next year. At this point, it seems like if we're going to get more Fed rate cuts than we assume right now, the market's pricing in about 2. If you're going to see a lot more Fed rate cuts, you would probably have to see a lot weaker numbers. So you would have to see the job openings coming down significantly. You would have to see the quits rate shooting down. Essentially, Josh, the economy not doing well in an economy that looks like it needs a lot of rate cuts. Economists look at this data and say this looks like an economy that's, it's doing all right. It's doing all right. It doesn't need immediate help from the Fed.
All right, Schaefer, point number 2.
Strategists coming out with more S&P 500 targets, and I want to hit on one trend, Josh. So first we'll highlight today was our new target, The new Wall Street high, Wells Fargo, 7007, little fun number there, a little James Bond reference for us. But one thing that Chris Harvey highlighted in that was a stronger than expected economy. And yesterday, you guys were talking to the head of U.S. equity strategy at RBC Capital Markets, Laurie Calvasina, and she talked about that economy. Josh, I want to play a clip for us and hear what she had to say.
Generally, what we've seen is that whether you're looking on sort of a quarterly basis or the annual forecasts, that GDP forecasts have started out too low and are constantly being revised up higher. That's the complete opposite of what we saw in the post-GFC world, kind of post-GFC pre-COVID, where GDP forecasts were constantly overestimated and had to be pulled down. I think that people, frankly, are still stuck in that post-GFC pre-COVID world.
So what Calvasina is explaining there, Josh, is the economy keeps coming in better than expected, right? So what she did in her forecast was she said, instead of 1.1 to 2, consensus is right around 2 right now, I'm going to go 2.1 to 3 as my GDP range. Look at what that does to your average annual return. A lot better than 1.1 or 2, right? And that's been a trend among a lot of these strategists is maybe the economy comes in better than expected, and that's usually a good sign for stocks. When you fall into this range, anything 1.1 to 0, you're probably in a slowing economy, which would mean perhaps we're headed for recession. Eventually that would hit corporate earnings. Right now it looks like you're still in a strong economic growth environment. That's a part of the reason why people think stocks go up.
We've had a couple strategists on this week who had their SPX targets for 2025. They were both like high single digits, I would say, Josh, is where they were kind of clustering.
Yeah, so if you flip over here, this isn't all of the targets we have. You go a little bit lower than 6,600, you're probably at the high single digit range, depending on where we close exactly today. This might be high single digits. It's kind of normal, right? That's basically saying we think stocks will have a normal year.
It's nice.
Perhaps,
it's nice. It's not
perhaps
fireworks.
Noteworthy though,
yeah.
the most important part of that, stocks almost never have a normal year. The average S&P 500 annual return is about 11%. It rarely ever actually returns 11%. So really what we get out of these targets is a little bit more direction than actual number. These numbers, they're going to move around a lot over the next year, but right now the direction that people think the market is going is up. Is it exactly going to hit 7007, Josh? I don't know. It'd be cool if it did.
We'll see. Joshua, thank you. Stick around. Much more asking for a trend still to come. Salesforce delivering a beat on revenue for the third quarter. The company also slightly lifting its full year revenue forecast. CFRA Research Senior Equity Analyst Angelo Zeno joining us now to discuss. Angelo, Salesforce reports this stock is surging more than 6% in the after hours. But walk us through the report, Angelo. What do you make of the results?
Yeah, I mean, listen, I think overall the results were fairly kind of in line. I'd say, somewhat mixed overall, but you kind of look at the quarter here, the October quarter, grew the top line about 8%. We were looking for about 7% increase, so kind of came in slightly better than expected. It was a slight miss on the bottom line side of things. We were looking for about 245. I think came in around 241 or so. More importantly is what they guided towards in the January quarter, and that was the fact that they're looking for top line growth of 8%. So the growth rates are finally starting to stabilize here for Salesforce. That's extremely important because if you kind of look since the pandemic, these growth rates have really come down from a rate of north of 20% over a year-over-year basis to now at the slowest rate the company has ever grown at about 8%. So I think the worst now is behind the company here as far as those growth rates are concerned, and now all eyes are going to be on 2025 and what the company can showcase in terms of their AI strategy.
And Angelo, importantly, you have a strong buy on this name. So not just a buy, a strong buy. You're a believer, Angelo. So what are the catalysts ahead that's going to lift this one still higher?
Yeah, so we're absolutely a believer of the name, and a couple of reasons for it. I think one, we've seen software really underperform here over the last year or so, at least relative to other areas of tech like semiconductors. We think software returns back more into favor into 2025, especially on the SaaS side of things, which has kind of been among the worst areas. Performing areas of tech. Now, when you kind of think about Salesforce specifically, why we like it, the concerns, the headwinds for Salesforce as far as AI has been concerned is that they've kind of got this, subscription-based offering out there being pressured by, enterprises out there. They can kind of have this kind of do-it-yourself approach out there, kind of hop on a Llama platform or what have it, do their own kind of platform. Or, you've got these productivity improvements that you're also seeing across the enterprise ecosystem, or that you will see across the ecosystem from AI. What Salesforce announced back in September, back as far as their Dreamforce conference is concerned, is very important because they announced their Agentforce AI platform. And that's important because it actually gives investors an idea of what this strategy is going to look like as far as AI is concerned. It actually puts Gen AI into action, and you've kind of got when you look at Salesforce, they've got all the data across your ecosystem out there. They give kind of the enterprise space a real reason to kind of go on and actually pay for the Salesforce platform out there as far as their AI strategy is concerned. And more importantly, it's not only going to be now kind of this subscription-based offering, but they've also kind of got this kind of consumption-based model out there where you're actually paying on a per-usage basis as far as AI is concerned. And that, we think, will help kind of improve the story for Salesforce going into 2025.
And when CEO Mark Benioff, Angelo, when he talks about this strategy of AI products, what are his competitive advantages in that big, fast-growing market?
I think it's the data that they have, right? It's all the access. When you kind of think about a company out there, I mean, whether you're a small, mid-sized, or a large company out there, you've got kind of you're very integrated if you're actually leveraging Salesforce's platform. You've got kind of all your data is essentially kind of across that Salesforce platform. So if you kind of throw this kind of agentic AI capability across your ecosystem out there, they kind of provide this seamless opportunity out there, or kind of integration across these different platforms. Whereas, for instance, if you're a company out there, you can actually kind of, have your own call centers out there, kind of essentially run by these, these AI agents out there, and they have access to across all the information across your organization within that kind of Salesforce platform. So that having access to that data is an extremely important part of this strategy for them.
Angelo, always great to see you and get that instant analysis and reaction. Appreciate it.
All right, thanks for having me.
Stick around, more Asking for a Trend right on the other side. take a look at what's trending here after hours. Shares of Okta surging after hours. Company beating analyst estimates for the third quarter. Adjusted earnings per share coming in at 67 cents versus estimates of 59 cents. Guidance also coming in strong for the fourth quarter. Company seeing revenue in Q4 between 667 and 669 million versus estimates of 651 million. Next up, take a look at Marvell Technology. That stock is soaring as well, following a Q3 beat on adjusted earnings. Company's guidance for the fourth quarter and the full year, both exceeding analyst expectations. CEO Matt Murphy saying he expects revenue growth to accelerate significantly year over year due to AI demand. And finally, the Campbell's Company is moving lower in extended trading. That's despite a beat on Q3 earnings. That's because it announced CEO Mark Clouse is stepping down. Mick Beekhuizen, president of the company's Meals and Beverages division, will replace Clouse as CEO. Mark Clouse won't be out of a job for long, though. He's going to become the new team president of the NFL's Washington Commanders. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.